Thank you very much. Good morning, everybody. Come on, stage. I think I'll come down and join you in a moment, but we'll start off from here. This session, as Jonathan says, is all about sort of accelerating growth and hopefully discussing in some detail about how the deals are getting done at the moment in the market, how we think they're going to get done going forward. We've heard some of the background from Alan Parker this morning about very positive market GDP growth, greater consumer and business confidence. I have to say, James, I think, was slightly more downbeat than most economists I've heard recently, and I've just come back from New York and the hotel conference there, and absolutely, I mean, the Americans have got two pace, forwards, backwards. They're absolutely going forwards, at a pace at the moment. But importantly, they see themselves as halfway through their cycle, perhaps. They talk in baseball terms, and they say there's 9 innings, and they may be on innings 4 or 5 at the moment. So they're seeing a lot more in the cycle, and everyone who's talking about the UK in particular from over there is very positive going forward. So I guess I want to ask the panel this morning how the sector has been driven, what the restrictions, what finance is doing to either drive forward or constrain some of the investment. And I think we're going to touch on a number of the areas, not just the equity, but the debt and any mezzanine and how the structuring looks on the transactions. We also really want to see if we can get out any ideas in terms of any new ways, any clever new ways of raising investment going forward. So on the panel today, we've got what I'd like to term the men with the money. 3 really from a private equity fund background and one from a banking background. And I'm going to allow them to do a 30-second intro individually, but just running across, we've got Eric Belkist, closest to me from Hutton Collins, Ron Pearson from Beaumark Capital, Heiko Fiege from Moorfield Group, and last but not least, Mike Saul, our banker from Barclays. So, Eric, do you want to kick off with your quick introduction?
Yeah, sure. I've been focusing on investing in the leisure and hospitality sector for the last 12 years or so. The prior transactions I've done in the sector primarily focused on restaurants. So, the public to private of Pizza Express in 2003. I've invested in the Wagamama restaurant chain 3 times. The public to private, yeah, it's the company that keeps on giving. It's wonderful. The public to private of the Loch Fyne restaurant chain in 2005, and most recently Cafe Nero and the Byron Burger chain. If you guys have ever heard of that, it's a bit newer.
Yeah, that's very popular with the Chancellor, isn't it? I think.
It is.
I'm Ron Pearson from Beaumark Capital. We're equity investors, and likewise I've been investing in the hospitality sector probably for the last 12 years. We've done a number of restaurant deals, backed a business called Living Ventures, which built up a chain called The Living Room. We have an investment in a Latin American chain called Las Iguanas, and most recently invested in a business called Drake & Morgan. So quite a lot of experience in the high street, but also we've invested in the travel sector. We built up a business in the schools travel sector. The great thing about that is you actually sell the holiday to the teacher who doesn't pay for it. The kid goes on it, but it's the parent that has to dip their hand in the pocket. So that's a fantastic equation there. You get a year's advance warning as well. And we're also an investor in a bed bank business called Jack Travel, which actually has both inbound and outbound. It sits between independent hotels and small chain hotels and online travel agents. And their growth areas in terms of inbound tourism for interest have been into Latin America. We've had a big increase in the customer base from there. And South Korea as well, which I didn't see coming, but it's great to be welcoming people from there.
Okay.
You done?
Yep.
I'll cut my 30 seconds short just to accommodate your 40. Good morning. Heiko Fiege, Moorfield Group. We are also private equity. real estate fund manager, I guess. We've been involved with the hospitality industry for very many years now. We currently own a number of Mercure properties, all in the UK regions, as well as the proud owners of 47 sharing hotels across the UK. Moorfield is exposed to a number of other markets and businesses other than the hospitality industry. We invest in office development, shopping complexes. We've got a beautiful retirement product called Audley. So any of you who are getting near this age of considering retirement, I've got a nice little place for you to go. Thank you.
Yeah, Mike Saul from Barclays. We've worked a hospitality and leisure industry vertical since 1998, and that has been incredibly empowering. So we look at all aspects of hospitality and leisure, anything from the sort of food and drink subsector, pubs, clubs, bars, restaurants, hotels, leisure operators, which is a whole remit from caravan parks to gaming companies to health clubs and spas. And then we also look at travel companies, so we look at the inbound and the staycation, the UK-based travel sector. And we also look after professional sports and the sports bodies. So it's quite an eclectic mix. And then the range of customers, we will take it almost from commercial level, which is above SME level, right up to full FTSE 150 type level, where we then work in partnership with our investment bank, helping develop the evolution of businesses, hopefully achieving with them what their targets are and their growth plans are.
Thank you, Mike. Well, you can see we've got a pretty broad spread of the hospitality industry this morning, and we've got about 30 minutes or so to talk through some of the main issues. There will be some time for some questions from the floor towards the end, so please do think of that. Perhaps I can just kick off, though, and be a little bit general, but where are you seeing the most activity now within the sector? Where's the most interest? And perhaps latched onto that, where are the sources of capital, the main sources of capital? How are these deals getting done? Don't know, Eric, if you want to kick off.
Yeah, I think in the restaurant sector in the UK, well, the restaurant sector in the UK has not grown as quickly as GDP. But the branded segment of the restaurant sector over the last 5, 6, 7 years has really outstripped GDP growth. And that is what has really attracted a lot of the private equity capital, which is backed by pension funds, university endowments, banks, high net worth family offices, et cetera, looking for the type of growth that's outstripping GDP growth, because that's really what underpins good returns for our investors. So as a result, there's been a ton of private equity interest in the restaurant sector. You guys are in it. We've been in it quite a lot. The banks, the gentleman from Coutts pointed out earlier that when it comes to SMEs, banks have been supporting companies and lending money, and he's right. I just came off the board of Nero, but I'm still involved with Wagamama and Byron, and our banks have been incredibly supportive. Our biggest issue is actually not financing the companies. Our biggest issue is because of the returns and because of the high cash flow generation that underpins the bank lendings from Barclays or RBS or whoever it is. Our biggest issue is actually finding the people and having the right head of HR, because when you look at the churn rates of your existing employees on the existing base, and then you're growing and you look at the churn rate for those as well. So it's really, it's a people issue, and it's finding the right people for the jobs that we're trying to create. It's less financing. I think when you move higher up the scale of the companies, I think the gentleman's right. The banks have definitely pulled back from a lot of that lending. But hopefully that's where a liquid bond market comes into play. I think we've seen that quite a lot.
Sorry, Heike, I was just going to ask Mike, just picking up on that point about sort of the HR. Is it a concern for you when you're lending about how they're going to execute the business plan?
Yeah, we have a huge dependency on the management team first and foremost. So experience and the level of experience now coming through, having gone through recession, that is a magnificent way of actually getting the extra credentials around how to deal with things on anything other than just an upward curve. So we will look at all aspects of a business plan, I think where we are today, when we were talking about this before we came on stage, a good business with the right credentials, the right management team, I don't think today will have any issues in getting the right funding structure, whatever that mixture is. And that includes startup, which is not typically a banking risk, it's more of an equity risk. And so the market is receptive to new ideas. And the hospitality and leisure sector particularly does have to keep reinventing itself. It has to be a bit of a futurologist about what it does and how it does. So as big a part of my job is looking at the operational solutions as a business, as well as the debt structure of a business. So we have to be cognizant of all the different aspects.
Yeah, I agree with that. I mean, you know, from a startup phase, the banks have gotten together. They've started the Business Growth Fund, which I think has been very helpful for entrepreneurs who are looking to raise equity capital. The government has, you know, the EIS investment scheme and the SEIS investment scheme, which are both, you know, very helpful because it's a very attractive structure for investors, private individuals to go into predominantly. There are a few EIS funds out there. The banks at the SME level have been pretty supportive. I don't know what.
Yeah, I mean, we've found, I think availability of debt is all around. And if you do have the right plan, and in particular, differentiated proposition and great management, I think finding funding will not be a limiting factor at all. And I think actually we're seeing, particularly as you go up the scale of businesses, that the availability of funding is almost back to what it was in 2007 in certain areas. And so some ways that kind of feels like there's quite short memories around. But I think the structures are slightly different. They're a little bit more modest in terms of more equity involved in the overall structures. But certainly there is no lack of funding available. And in fact, there's a lot of new debt funds that are interested in coming into the market. So actually the good news from investors' point of view is that I think the cost of banking is actually going down a little bit. Only a little, but it's going in the right direction.
I don't think quite enough, but I think the only thing that I would add is that you just alluded to, if you have a story to tell, there's likely to be debt available, and that's very, very true. The trouble is, if you look at particular UK regions that we concentrate on, I think the majority of business that you actually look at nowadays have a good story to tell, and the story is, let's go and invest in these properties. Let's get the performance back to the levels that we used to enjoy in previous years, so therefore there's a good story, and this story is hugely backed. What I'm suggesting for us in our case is we have a committed discretionary capital available to be able to make acquisitions out there, and I think Moorfield would consider itself to be a net buyer. However, it has got very, very competitive out there now, whereas perhaps as recent as 12 months ago, you may be competing against one other entity. I think it has got much more competitive out there now.
It's good if you're an operator there.
That plays on. I was going to sort of ask, from getting deals done and in a practical way, what part of the equation is the most challenging at the moment? And you've talked about the debt being relatively freely available. You know, I think if you look across the capital stack, are you seeing bits which are sticking, or is it really just the competition in winning the transaction and then putting it together?
Sorry if I may. I think debt in general is not the issue. I think mezzanine is still a bit of an issue there because there's a bit of a disparity between debt that you get and mezzanine that you're asked to pay. So I think that gap has to narrow a little bit. But ultimately, it's just down how much risk are you prepared to take? What, do you believe the story? Do you believe that the recovery is going to be sustainable? And do you really believe that at this stage of the cycle, that there's durability within the cycle, that you actually hit it at the right time? There's a lot of optimism out there, and rightly so as well. I think if I look at our portfolio, which is managed by our friends from Accor here, I think we've now seen 14, 15 months of sustained RevPAR growth in the vast majority of our hotels. And if we are representative of the regions, then I would suggest there is a lot of optimism out there.
I think the other point is we've seen significant deleveraging occurring in the market. So whilst we've been putting out lots of new debt, it's being repaid, and the accelerated repayment is something that we've got to manage. The confidence levels generally seem very high. So when we look at all the management accounts that we get from operators where they're achieving their own budgets or not, and most of them by definition will have some growth aspect to them, it's the exception rather than the rule where they're not meeting their own budgets. So they themselves are confident, And I guess if we've got
Is that because they've been conditioned over the last few years to set really soft budgets?
Well, no, I wouldn't say that's the case, no.
Well, it has been difficult, though, to look ahead and start, and I think it's only in the last 6 months that people are really aggressively underwriting growth into some of their projections.
I look back at some of the companies that I've dealt with over the years, and the irony of it was, in the downturn in 2009, everybody that I was looking at, the data set I was looking at, everybody was kind of pulling back on we've got organic growth, but we want to roll out new sites across the UK. That's what we're trying to do. And everybody really pulled the lever and reining in opening new sites. But when I go back and I look at the cohort of sites that were opened in 2009, 2010, the return on capital on those sites is far superior to many of the other years. And it was just because, landlords were a bit scared. You were getting better deals, better landlord contributions, better rent-free periods. Today, to a certain extent, I think the landlords are in the driving seat, particularly in London. The property market is so competitive at the moment.
Yeah, I mean, the London property market, I've described it as being white hot at the moment.
Yeah.
Not only for the residential, but also in the commercial sense. There's a lot of competition, so we're tending to focus outside London in terms of our rollout.
Yeah, so I think we kind of went off a tangent on your question, because when you're asking about, is it tough to get the deal? Well, there's getting the deal and buying the company, but then there's also having a good property director in place to find all the multitude of property deals that you need over the years, and the HR team to support that to get it done. And the property market, finding the companies to buy has been incredibly difficult because there's a lot of private equity capital out there. But you can get it done a little bit, but the property market has been tough.
But there is a big interdependence between the different aspects of hospitality and leisure. So if we look at a hotel, we shouldn't ignore the restaurant opportunities. Restaurateurs should be talking to hoteliers.
Absolutely.
We look at shopping centres, Westfield with a really successful casino on the top of it. So it's about making the wider links rather than being stovepiped to just hotels or restaurants or leisure operators, looking at the entertainment spend from tourists as an example. And so when we talk to people that are looking for new sites and to expand, the research that the business has to do is about the wider leisure spend rather than just that particular stovepipe.
That's absolutely right. I mean, there's definitely a trend that I'm seeing of, leisure center investment and restaurants opening in leisure centers. I was looking at one in Bournemouth yesterday. There's a new cinema complex that's going in there with, 10 big screen cinemas, and they want to put in, 20 different restaurant concepts, and so everybody's going to be looking at that. The spend on the high street, I think, has definitely shifted from the high street to a certain extent to Westfield White Cities, Westfield Stratford, these other leisure centers that you're talking about, and that's definitely an area where it's good to be collaborative to look for the growth that we need.
Does that mean you're, from a restaurant point of view, you're not looking at the high street? I mean, you hear quite a lot of retail, the woes. So, sectors of the retail are going strongly, but there's big swathes, especially outside of the UK, where we've got too many shops.
No, we're definitely looking at the high street, and we're aggressively trying to get local councils to let us convert A1 sites to A3 sites. That can be problematic. It can be difficult. There's definitely, some grassroots movements out there that are anti-chain, whatever that is. But at the end of the day, what we're trying to do is we're trying to bring a differentiated concept at an affordable price point, but with an acceptable gross margin for us that's got consistent quality to people around the country that they're going to enjoy. And the high street has been difficult, but we're still looking at those sites, and leisure centers are a big play as well.
Okay. And Mike, you Barclays have done some research on the sector, on the sort of dynamics in the sector, which I guess is playing to what Eric's saying. I mean, what are the key takeouts from that?
So we looked at the tourism dynamics, which interesting to hear the conversation earlier about visas, and we look at the US, Germany and France. They represent the top 25% of numbers and expenditure, but by far the biggest spend, by a factor of 3, is the UK domestic tourism industry, which is set to grow by something like 25% over the next 4 years, but the inbound tourism market is set to grow off a lower base by something like 33%. And on the pure H&L side, it's a fairly equal growth in food and drink, entertainment, and accommodation. So our research across quite a wide audience of research participants was that they are expecting on a level playing field significant growth. So the takeaway figure is that we look at about 108 billion for UK total spend by tourists, and the overseas market grows significantly to something like 26 billion. So looking at that on a standalone basis, that again tells us that the UK is a destination, and to harness that UK staycation market is an area of focus.
And you know, I have to say this is extraordinarily good news, because we tend to sit in these forums and talk about London, understand why we're talking about London. But the reality of the matter is there's a world outside London, actually not too far away. And whilst I'm very envious that Thomas is filling his hotel tonight here, I would suggest equally you would be hard-pressed to find a mid-market regional hotel room tonight. Indeed, just to follow up what you just said, we have seen an extraordinary improvement, particularly in weekend occupants in our regional properties out there, which probably confirms what you're saying, that holidaying and spending time in the UK in regional properties is fashionable, and is something that's likely to continue, which is part of the good news story that we talked about earlier. And the other thing I just want to pick up, you're right, hotels are not just beds. Hotels are about the whole experience of staying in it, and I think hoteliers that we're talking to have become very creative now, and look in particular at their food and beverage offering to say, look, reality is we're hoteliers, we know how to sell bedrooms, but we're probably not quite as savvy when it comes to filling our restaurants and our restaurant tables, and are starting to contract out to the experts, allowing them to come into the business itself and work in a partnership, be it on a franchise basis or be it just simply contracting, leasing out this space that probably would be underutilized.
Okay. If we can turn very briefly to the hotel market rather than sort of restaurants, which is sort of, I guess, my main focus. We've seen a real uptick last year in terms of transactions. We recorded just over £3 billion worth of UK hotel investments last year. We're forecasting about a 20% growth for 2014, and I'm pleased to say sort of where we are, we're probably on course. There's about £1.5 billion already being transacted, and that excludes the big loan note sales, the Project Rock, which was the IBRC loan, which was nearly £1 billion worth of hotel products. So it's all very positive, but about 40% or so of that was private equity, and I guess our panel probably sort of reflects something of that trend. Is there a concern that the regional market, perhaps in particular, where it was about 46% private equity, is being swallowed up by these big players, and who's going to buy the smaller sort of assets as we look forward?
I don't know. I mean, if I may, sorry. We have very few of our properties on the market. Incidentally, if you're interested in good regional hotels, we've got 5 of them. They were selling at the moment as part of reshaping our portfolio. And certainly as far as Morford is concerned, of course we're interested in portfolio deals, and we probably participate in the bidding for those. But equally, we're interested in good quality assets, individual assets that we can build on to our existing infrastructure we have, particularly where there's an asset management angle there. Private equity, as we already spoke about, it may be slightly easier for us to secure debt, and that by definition makes us a key player when it comes to the markets out there. But I have to say, certainly as far as Morford is concerned, be it portfolio or individual assets, we look at both.
From the investment opportunity, the financial sponsors are looking for hotel assets as an asset class because they see it as a good growth opportunity. In London in particular, some of the trophy sites or some of the property prices are just making people look for some of the regional play. So in the last year to 18 months, we've seen a lot more interest in the regional hotel model and that market stabilizing. It's much more fundable, and I don't mean from a bank perspective, I mean from an investor perspective as well as a bank perspective. So it does seem to be quite hot property, the hotel as an asset class. For the money that's available, there are a lot of people looking to get involved. Typically, we're looking at bigger groups rather than single-site asset, but it is a difficult situation to buy anything in London, and a lot of that is being bought for cash and then refinanced out afterwards, or temporary loan and then put into a permanent investment loan.
Yeah, we were looking at potentially getting into the regional hotel market last year, but actually were outcompeted by Starwood and people like that to find the platform assets. But for us, we need the platform asset to then be able to build a group, to try and create a new group that actually has a presence in the market. But one needs, if the platform assets get picked up by even bigger players straight out the gate, then you just don't have a starting point as far as we're concerned.
No, and certainly there was no sign that they're letting up on this. I mean, I must have done, 15 meetings over the last 2 or 3 days, and everyone's saying, right, we want to tag things on, and we're willing to pay for some of the synergies that we bring to the deal to get it over the line, which means that they can be 10% above a lot of the other buyers. Now, but the good news is that actually, when they start reshaping these portfolios, there'll be some assets which are coming out at the other end. And from a management focus point of view, I think that's where the opportunity is for the broader UK market to pick up on that. And someone with slightly different skill sets can deliver the service which is needed, because at times, it doesn't always filter down to the grassroots level. And if you look across the industry, there's a lot of very good small businesses out there as well who are performing. What about other smaller investors? What about the role of the smaller investors? I know you sort of will pick up with not necessarily the Starwood Capital, Mount Kellett size deals, but the individuals out there. I mean, one topic we were discussing was crowdfunding, and whether anyone had seen that coming in, so the individuals can get into the sector. Are you seeing any of that in hospitality?
Well, we haven't seen it yet, but I'll have to say that I like the idea of it, incidentally. I think it's a great idea, particularly for startups. But more importantly, what tends to happen across in the States, at some stage, makes it across to the UK. That's about as certain as anything. So I wouldn't be surprised that over time there will be an opportunity to look at our industry as well, certainly for startups.
But I think even there's not many. I mean, I was talking, there's one in Manhattan, someone was doing.
There's one in the States at the moment where they've done that very cleverly for signature site as well, for that matter. So you really would want to get involved in it.
We haven't seen a prolific. We've seen a couple of people talking about crowdfunding. More for the startups, we still see the likes of the angel investors. So that's not a new concept, that's an old concept. People like the Business Growth Fund that we talked about earlier, they come in, but they will only come in for an established business. They don't want to do a startup situation. We are seeing still a consolidation of what was a fairly fragmented industry. So something like caravan parks, for example, that did suffer because that was subject to the vagaries of confidence, and people stopped taking those regular trips. But I still think around the UK, the different tourism bodies need to look at their particular model in their particular locality about what works for them. So we've seen, for example, in Yorkshire, the Tour de France, when that went through Yorkshire, that was a massive impact, and that was a major event for them. So part of what we're encouraging is people using as much research, CRM systems, looking at their cost of acquisition, how do they get and retain and upsell. And so a lot of what's going to help stimulate this economy and encourage people to spend is how the operator goes about keeping and selling more to their clients, and as we talked about earlier, selling across the leisure industry.
Just coming back to the crowdfunding, how do you know how it works in terms of control? Because the biggest nightmare must be to have 400 stakeholders in your business. So control, and then the flip side for them, the liquidity to get out of the transaction.
I'm pretty opinionated when it comes to crowdfunding.
Go on, go for it.
The last big crowdfunding deal that I'm aware of that was done in the sector was a brewery up in Scotland called Brewdog, and they've got good beer. I mean, it's good beer, but
that's an emotional investment, isn't it?
Well, yeah. I've come to the conclusion that a lot of the people who invested in the crowdfunding just kind of believed that they were joining a club and getting some sort of a discount or something like that. Because if you look at the enterprise value that they're placing on the company relative to its profitability, I think, I'm not sure, I think that it was something like 100 times EBITDA, which is insane. And why would an educated investor ever participate in something like that when they have the ability to participate in SEIS schemes or EIS schemes style investing in the UK, that are well thought out, that you have good tax advantages, and you're probably paying a valuation for the company that is a lot more reasonable than that one. I think crowdfunding will probably get more regulated as time moves on. I think it should. And I think that there's a risk there that investors who want to be involved with a concept end up paying astronomical valuations that really aren't justified, and really they're not, educated as to the risks on that. That's I think the big risk. But let's see how it plays out.
Well, I think some of the valuations that have been paid for some of the dot-com companies at the moment,
well, exactly.
you might question the sanity of some of the professional investors as well.
Yeah, no, look at Uber, 17 billion or something.
I don't understand that. Personally, I think if crowdfunding could actually provide the startup funding to a number of newer businesses, I think that would be excellent. Whether they ever get a return on it, I think is very questionable, particularly if it is at 100 times EBITDA. But I think anything that can encourage and make available funding to new ideas and new businesses has to be welcomed. I think we're at a stage of the investment cycle that is 3 to 5 years further down the line. So more and more businesses that are coming and being available and proving themselves just has to be welcomed. So I can't see that it's going to be a big element of funding overall, though, I have to say.
I agree with you. I think we definitely welcome more capital into the market. I just, they say that your average investor should buy index funds and not, worry about buying individual stocks, because that's a whole skill set and value in stocks. Well, okay, fine. Should individual investors be investing in venture capital startups at really high valuations? I just know, I can get there with an SEIS scheme or an EIS scheme, because they're getting certain very beneficial tax advantages to that. So there's a lot of protection there for the investor. Yeah.
Would you lend to that, Mike?
Yeah, I think as long as the capital that's raised, and it's important that it is treated as capital and not got some other sort of coupon or commitment attached to it, because we would also look at what rights this shareholder has got, because the leverage on paper is just unsustainable. So from a banking perspective, if the money is being raised for a crowdfunding mechanism, we would need to understand the terms and conditions behind that, because if we're going to be asked to do anything around senior debt banking funding, it would obviously need to be postponed behind that interest. So we've yet to see anything meaningful in terms of the structure and what it would look like in terms of the covenant structure and how we'd look at it from a leverage perspective.
Okay, before I take some questions from the floor, maybe, I just want to ask you, Mike, to what degree, we talked earlier a little bit about the other lenders coming to the market, the institutional ones. To what degree is that affecting the business of the traditional clearing banks and your approach, if you've got the MetLifes and AIG and others who are coming in to provide longer term loans at maybe more competitive pricing?
In many cases, it's very welcome, because it's another option for the companies to look at how they would structure it. So we do participate equally with some of these funds, these unitranche type funds that are coming into the market. It is a new dynamic. They tend to be they're not typically cheaper, but they would typically be a different structure. They might not have a repayment mechanism. They may just be a bullet repayment. It could be that it allows us on a joint basis possibly to put out another half turn of leverage, for example. It depends on who it is and where it is, but we are seeing more interest from some of the funds coming in, and it's not a problem. We're kind of working a joined up approach to it all, really. It's still early days, but we're working through it.
Okay. And just on a sort of broader market perspective, I mean, to what degree is red tape still a massive issue? The regulation, you talked about planning, there may be sort of broader economic considerations, the battle on VAT, which I know is a constant topic for Ufi and the team. Are you seeing those constraints as holding back what you can do, or are they set at a sensible level now, do you think?
If I may, sorry, I'm also board director of VHA, so we'll of course talk about VAT because it is an important issue. Why should this country be disadvantaged when it comes to VAT versus other European countries? If we build ourselves as a destination, will encourage increased employment in our sector itself, then it's got to be done on a fairly level playing field, and at the moment it isn't. It isn't. 20% VAT is by far ahead of what other European countries are actually charging. It goes down as low as 7% in some of them. And I don't think we should rest as the industry, the BHA, until this gets addressed. So yes, I think it has some bearing on what we can expect in the future, of course.
Other regulations issues?
Go ahead.
I was just going to say, to be quite honest, from an operational point of view, the companies that we're invested in, we're not really seeing a major blockage to expansion coming through regulation, to be quite honest. It does feel as if the pressure is on from whether it's additional pensions, obligations and things like that. There's increasing pressures, but I would say that's not the major concern. Going back to Eric's point earlier, it's actually finding the people rather than, and it's becoming more competitive to find the people. The regulations don't make it easier, but or the obligations don't make it easier, but actually there are more fundamental issues. So personally, I don't think regulation is a major blockage to growth at the moment.
Let's see, for me, I think, well, again, the gentleman from Coutts, he had a lot of good things to say. He talked about housing shortage in London, and he's right. There is a lot of brownfield development that could be done, not only in London, but in the UK. And, you know, I'm not talking about new development, greenfield development. I'm talking about brownfield development where, you know, land that had been developed previously can be reclaimed, it can be cleaned up, things can be done with it. I see it everywhere I go, not just in London. And I think the more the government can free up constraints around brownfield development, the more the economy will develop.
Okay. Do we have any questions out from the floor? There's a roving mic. The lady there, you were...
Eric, you started very well with the point about the people. So if, for example, the companies will decide to invest a bit more in the training of the staff, as well as the whole industry and government will try to change the perception of the actual industry between the eyes of the young talent, would that help you create more attractive opportunities for the investment?
Yeah, I think so. I mean, the people issue is a big issue. You know, when you're trying to take a burger chain from 40 restaurants to 100, you're talking about a people problem, which is thousands of people. It's expensive. It's expensive to hire people. But if you train them well and you keep them happy, your employee turnover will be lower, and employee turnover is very expensive as well. So yes, I think investing in training is absolutely key, not only from just, it's a good thing for the economy, but you know, it's also a good thing for the stakeholders in the company because it keeps recruitment and employment costs down. And there's a certain something to walking into your favorite restaurant and recognizing the people there and not always having new people serving you who don't necessarily know what they're doing and you know, they recognize you, you know. He wants the cheeseburger or whatever it is. You know, I think there's a huge benefit to that.
Is there anyone? Gentleman there? Then we've got another one at the back there. Sorry, hidden in the lights.
Hi. Eric, just on that point as well, on people, I own a boutique recruitment company specialising in hospitality. We've grown organically over the past few years pretty well. We're looking to expand and our clients are asking us for our staff across Asia now and Europe. How would you propose a company like ours or other similar companies acquire capital to grow? Because organic growth is quite painful, as I'm sure you're aware. Yeah, what would be your advice?
Okay. I think, well, I'm not sure how large I'm not sure how large your company is, and I'm not sure what your growth aspirations are. But as the economy grows, and as the sector we've been talking about grows, hopefully your business should grow along with it, particularly in the, you know, focusing on the branded sector. As I said, I believe that growth has been outstripping GDP, so that's got to be good for you as an equity holder in your business. So hopefully you should be able to pitch that to other friends and family. Again, you know, I know I keep talking about SEIS and EIS schemes, but I just think that the tax advantages of them are so huge for potential investors. Not only could you sell potential investors on how your business is going to grow and what you're going to do with it, but also and you also get these great tax advantages as well. And so I've invested in a couple of EIS schemes on the side, and those tax advantages really got me over the line, because you're looking at 100 units of economics and potentially 30 units of downside if the whole thing goes wrong, or even less. So I would definitely look into that. I'm not sure why that doesn't seem like the general knowledge of that type of investing to fund new companies is out there. I don't know. I don't hear about it a lot, but I think it's fantastic.
I think there's sometimes a degree of distrust of anything which seems to be too good to be true. So maybe that message needs to come across that it is.
I mean, it's a government program. You can, learn
That's
about
where
it
the distrust is.
online. Yeah.
You might also just to throw it in. You might also try Business Growth Fund, which is actually the development capital element
for sure.
of being able to expand businesses. That's sort of
for
essentially set up to support businesses like yourself.
Actually, my chairman of Byron is he's an NED on the Business Growth Fund, so I could put you in touch with him if you wanted that.
There's a question from the back there, I think.
Hi, it's Robin Rodent from Yo Sushi. Question for you guys: the IPO market. You haven't mentioned it. I mean, it's come back. I mean, what's your feeling about it for the hospitality industry, for refinancing?
So did you catch that?
I didn't
what
I'll try again. The question was, you haven't mentioned the IPO market. I mean, it's come back. It's obviously a bit fragile, but what's your views in the next sort of a year or two for our sector? There's a lot of people looking for money.
It's good to see you again, Robin.
Yeah.
Look forward to seeing you this evening. I've never taken a company public, so it's tough for me to comment. I've taken companies private, but I've never actually taken one public, so I'd have to defer.
Well, people, funnily enough, we've got a business that just might be for sale in the next year or so, as are all private equity businesses. But and people have tried to encourage us to go down the route of an IPO. I think if you've got the right business and you've got the people that want to do it, it certainly should be an option. But that window of how long that's open in the IPO market, I don't know, perhaps we can get a better view from an investment fund manager.
I kind of draw a parallel with the high yield bond process. I've done a few of those in the past, which is another publicly traded instrument. There's a lot of workup that goes into an IPO. There's a lot of workup that goes into a high yield bond. There are a lot of lawyers' fees. There are a lot of legal fees. I kind of think of it in terms of how many restaurants worth of capital would I have to spend to go down that road. And it's probably 2, maybe even 3. And then at the last minute, you don't know if you're going to, in the case of a bond, you don't know, you can probably get it away, but it's what interest rate am I actually going to pay? The banker said I was going to pay 8%, but now they're coming back and they're saying it's 9.25%. Does that really work? That's hugely disappointing. The IPO market, I guess, has probably got to be similar. So it's a risk, and it's a calculated risk, and you've got to, take that leap, I guess. But, public equity investors can be very helpful in terms of, Luke Johnson just got one. Luke Johnson, who's got to be one of the greatest investors in the sector, just got away Patisserie Valerie. That is a huge success story. I don't believe he was taking any money off the table, and I think that capital was all for growth. So, the deals are definitely getting done. It's just whether or not you're willing to take that leap of faith and invest the capital.
We've probably got time for one more quick question, if there's one out there.
One down there.
Jonathan, was that you?
Vigorous waving over there.
Yeah. I might call you James, actually.
Hello. Yeah. Meredith Bevan from Shiva Hotels. Question to the panel, really. T2 at Heathrow opened yesterday, and it's quoted as being, if the Heathrow is the gateway to the UK, it just got a new door. If, from an investor's view, where would you put your money? In a new airport in the estuary across the other side of London, or would you put it in a third runway at Heathrow?
I said a quick question.
Wow, I've never been a huge fan of eminent domain, and my understanding is to put a third runway into Heathrow, that is what would have to occur. That said, I get the fact that the country needs another runway. I don't know. Could they put another one at Gatwick?
I think it's, you look, do we need additional runways? Absolutely.
Yeah.
I just wish that somebody would make a call on this and say, this is what's going to happen now. You talked about Gatwick, Stansted.
It goes on
You're
forever.
talking about Luton. It goes on forever and ever and ever. And isn't it just typical of us? We perhaps also congratulating us that we opened Terminal 2. Actually, Terminal 2 is, I'm sure, a very nice terminal, but something that this country should have had, or London should have had very many years ago. It's been taken on far too long. Terminal 5, Terminal 2 came on, and I have to say, when you come from another country and you land at Heathrow, depending on what terminal you get into, it is somewhat embarrassing, some of the terminals that you're actually arriving at, apart from the fact that it still takes far too long to process you into the country, if you will. So it's not so much about whether it's Heathrow is the right destination, it's about let's increase capacity at our airports.
If you think about Heathrow as being full, the extra strip is needed. If you look at the other parts of the UK, Manchester being an example that I talked about somebody earlier this morning, Manchester is only half utilised. So is the question also about what other parts of the UK could become a hub similar to Heathrow, because we're going to have congestion. Crossrail will open, it will get congested, it will all max out at some point, and I guess the infrastructure is the other concern. So,
absolutely.
And there's huge development going in at Manchester with the airport group and their JV with Carillion and the Beijing construction group, to construct their airport city. So the logic of spreading the base is certainly there. I think, sorry, Eric, you've got a final thing?
I was just going to say, I don't know what to say about the Thames estuary other than Hong Kong did something similar, right? So maybe it wasn't as far away, but I mean, it can't be done, I guess. I don't know.
I think, technically, I think that it's not as tidal there. But
there you go.
We'll find out.
I don't know.
Could be slightly expensive compared to even HS2. So.
Right, we're out of time, and I'm conscious I'm stopping you going to have a much-needed coffee break. Before we thank the panel, though, just as a bit of housekeeping, the coffee break is downstairs in the Chablis room, or Chablis suite, I should say, now. We would ask you to be back here promptly in this room by 11:40. We've got Fergus Ewing, MSP, next on stage. So thank you very much to the panel. Great. Enjoy your coffee.